Vocabulary highlighted in the book, Investing for Dummies by Lindell T.Y. 1. The stock market is a place where investors can buy and sell shares of publicly traded companies. 2. This capital can be used to fund the company's operations, invest in new projects, and expand the business. 3. Investors can make money in the stock market in two ways, through capital gains and dividends. Capital gains occur when an investor sells a stock for more than they paid for it. Dividends are payments made by a company to its shareholders as a portion of its profits. For there are many ways to invest in the stock market, including buying individual stocks, investing in mutual funds or exchange-traded funds (ETFs), and using robo-advisors or financial advisors. 5. While there is always some level of risk involved, historically the stock market has outperformed other investments over the long term. 6. Secondly, investing in the stock market allows you to diversify your portfolio. 7. This comes with the caveat that there is always some level of risk involved. 8. However, like any investment, there are both benefits and risks associated with it. 9. Although there is no guarantee of high returns, the potential for high returns is one of the primary reasons people invest in the stock market. 10. Liquidity. Stocks are highly liquid investments, which means they can be easily bought and sold. This allows investors to quickly and easily sell their investments if they need cash. 11. Volatility. The stock market is volatile, meaning it can fluctuate wildly in short periods of time. 12. Market risk. The stock market is subject to market risk, which is the risk that the entire market will decline. 13. Stock. A stock is a type of security that represents ownership in a company. 14. Dividend. A dividend is a payment made by a company to its shareholders, usually in the form of cash or additional shares of stock. Dividends are often paid out on a quarterly basis. 15. It is calculated by dividing the current stock price by the company's earnings per share. 16. High volume often indicates that there is a lot of interest in a particular stock. 17. The difference between the two is known as the bid-ask spread. 18. Bull market/bear market. A bull market is a period of rising stock prices and optimistic investor sentiment, while a bear market is a period of falling stock prices and pessimistic investor sentiment. 19. Common stocks are different from preferred stocks, which give shareholders a fixed dividend payment but no voting rights. 20. That being said, common stocks generally offer higher returns than other, less risky investments such as bonds or savings accounts. 21. Look for companies with strong financials, a solid business model, and a history of growth. You should also consider the industry the company operates in, as some industries are more volatile than others. 22. By diversifying your investments, you can help protect yourself against market volatility and minimize your risk. 23. Preferred stocks are a type of stock that has a fixed dividend rate and priority over common stocks. 24. Additionally, preferred stocks generally have a higher dividend yield than common stocks, making them attractive to income-seeking investors. 25. Cumulative preferred stocks require companies to pay any missed dividends to shareholders before paying common stock dividends, while non-cumulative preferred stocks do not have this requirement. 26. This can make preferred stocks a good option for investors looking for stability in their portfolio. 27. One disadvantage is that they are less liquid than common stocks. This means that there may be fewer buyers and sellers, making it more difficult to buy or sell preferred stocks quickly. 28. Overall, preferred stocks can be a good investment option for income-seeking investors looking for stability in their portfolio. 29. These stocks are considered to be the safest and most reliable investments in the stock market. They are called blue chip stocks because the term blue chip originally referred to the highest value poker chip, and the companies represented by these stocks are considered to be the highest value companies. 30. These stocks offer a stable and predictable return on investment, as well as the potential for capital appreciation over time. 31. In summary, blue chip stocks are a great option for investors who are looking for a safe and reliable investment opportunity with long-term growth potential. 32. Growth stocks are popular among investors who are looking for capital appreciation or an increase in the value of their investment over time. 33. One way to invest in growth stocks is through mutual funds or exchange-traded funds (ETFs) that focus on this type of investment. 34. Value stocks are shares in companies that are currently undervalued by the market. 35. Value investing is a popular strategy among many investors, including some of the most successful stock market investors of all time, such as Warren Buffett. 36. By investing in companies that are already undervalued, investors have a cushion against potential losses. In addition, value investing can be a way to avoid overpaying for popular, trendy stocks that may be overhyped. 37. There are two types of stockbrokers: full service and discount. Full-service brokers offer a wide range of services, including investment advice, research, and portfolio management. They also charge higher fees than discount brokers. Discount brokers, on the other hand, offer fewer services but charge. 38. If you're a beginner investor with a limited budget, a discount broker may be a good choice. 39. When working with a stockbroker, it's important to communicate your investment goals and risk tolerance. 41. There are two types of stock analysts: fundamental analysts and technical analysts. 42. Technical analysts, on the other hand, focus on analyzing price and volume data of a company's stock to identify trends and patterns that can help predict future price movements. They use charts and graphs to visualize this data and make predictions about where the stock price is headed. 43. These investors play a pivotal role in the stock market, as they have the ability to move large amounts of capital and influence stock prices. 44. This allows them to make informed investment decisions that are based on data and analysis, rather than emotion or speculation. 45. Unlike individual investors who may be focused on short-term gains, institutional investors tend to take a longer-term view. 46. Market makers are firms or individuals that buy and sell securities such as stocks on behalf of investors. 47. Market makers are typically compensated by the bid-ask spread, which is the difference between the price at which they buy and sell securities. 48. Investors should be aware that market makers may have conflicts of interest. 49. Fundamental analysis is used by investors to make informed investment decisions. 50. An undervalued stock is one that is trading below its intrinsic value, while an overvalued stock is one that is trading above its intrinsic value. 51. The first step in conducting a fundamental analysis is to review the company's financial statements. 52. Economic indicators can have a significant impact on the performance of individual stocks and the stock market as a whole. 53. Market trends are patterns that emerge in the stock market over time. 54. Technical analysis is the study of past market data to identify patterns and trends that can help predict future market movements. 55. This is done by analyzing charts and graphs that show the historical performance of a stock or market over time. 56. A moving average is a line that shows the average price of a stock over a set period of time, such as 50 or 200 days. 57. It is a momentum indicator that measures the strength of a stock's price relative to its past performance. 58. Other tools used in technical analysis include chart patterns such as head and shoulders or double tops and bottoms, and trend lines, which show the direction of a stock's price movement over time. 59. Assets are things that the company owns, such as cash, property, and equipment. Liabilities are debts that the company owes, such as loans and accounts payable. Equity is the difference between assets and liabilities and represents the value of the company that belongs to its owners. 60. Revenue is the money that the company earns from its operations, while expenses are the costs of running the business, such as salaries, rent, and supplies. 61. Cash from operations is the cash generated from the company's normal business operations. Investing activities include buying and selling assets such as property and equipment. Financing activities include taking out loans and issuing stock. 62. When reading financial statements, it's important to look at trends over time. 63. In addition to reading financial statements, investors should also pay attention to other factors that can affect a company's stock price, such as industry trends, competition, and economic conditions. 64. It tracks the stock prices of 30 large, publicly traded companies in the United States. 65. Volatility Index, VIX. This indicator measures the level of fear and uncertainty in the stock market. 66. If the DJIA and S&P 500 are both trending upwards, it's generally a sign that the market is doing well. 67. It's important to remember that stock market indicators are just that, indicators. They can give you a sense of where the market is headed, but they can't predict the future. 68. However, investing without a clear set of goals can be risky and unproductive. Setting investment goals is crucial to make informed investment decisions that align with your long-term financial objectives. 69. Defining your goals will help you prioritize your investments and allocate your resources accordingly. 70. If you are risk-averse, you may prefer conservative investments that offer steady returns with low volatility. 71. Short-term goals may require investments that offer liquidity and low volatility, while long-term goals may allow you to invest in high-risk/high-return assets that require a longer investment horizon. 72. It is a common saying that you shouldn't put all your eggs in one basket, and this is particularly true when it comes to investing. 73. One way to achieve diversification is through mutual funds or exchange-traded funds, ETFs. These funds invest in a variety of stocks, providing instant diversification. 74. Another way to diversify your portfolio is by investing in bonds. Bonds are a type of fixed income investment that provide regular income and can be less volatile than stocks. 75. In summary, creating a diversified portfolio is essential for any investor. 76. A brokerage firm is a company that acts as an intermediary between you, the investor, and the stock market. 77. One of the most important factors to consider when choosing a brokerage firm is the fees they charge. 78. Stock market orders are instructions from investors to stockbrokers or the market to buy or sell a particular stock. 79. Limit orders, on the other hand, allow investors to specify the price at which they want to buy or sell a stock. 80. Stop orders are used to limit losses or protect gains. 81. Stop orders can be useful in volatile markets, but they are not guaranteed to prevent losses if the stock price gaps down. 82. Trailing stop orders can be useful for locking in gains while allowing for further upside potential. 83. Market orders provide immediate execution at the current market price, while limit orders allow investors to specify the price at which they want to buy or sell a stock. Top orders are used to limit losses or protect gains, and trailing stop orders allow for further upside potential while locking in. 84. The buy and hold strategy is based on the idea that the stock market tends to go up over time. 85. The buy and hold strategy is particularly attractive to beginner investors as it requires minimal effort and knowledge of the stock market. 86. The buy and hold strategy also offers several advantages over other investment strategies. For one, it eliminates the need for frequent trading, which can be costly in terms of transaction fees and taxes. 87. Additionally, the buy and hold strategy requires patience and a long-term perspective, which can be difficult for some investors to maintain. 88. Additionally, the buy and hold strategy requires patience and a long-term perspective, which can be difficult for some investors to maintain. 89. By focusing on quality stocks, diversification, and a long-term perspective, investors can benefit from the power of compounding and achieve long-term wealth accumulation. 90. The key advantage of dollar cost averaging is that it removes the need for investors to try and time the market. 91. Dollar cost averaging is particularly beneficial for those who are just starting out in the stock market and want to minimize the risk of losing money. 92. Overall, dollar cost averaging is a simple yet effective investment strategy that can help investors build a diversified portfolio of stocks and achieve their long-term financial goals. 93. The goal of value investing is to find undervalued stocks that have the potential to outperform the market in the long run. 94. He famously said, "Price is what you pay. Value is what you get." 95. Investors should also consider qualitative factors, such as a company's competitive advantage and management team. 96. This strategy is based on the belief that investing in companies that are growing rapidly will lead to higher returns in the long run. 97. Companies that are in the early stages of growth often have higher volatility and may experience significant fluctuations in their stock prices. 98. However, it's important to remember that sector investing comes with its own risks. Because you are investing in a particular industry, your portfolio may be more susceptible to economic or regulatory changes that impact that industry. 99. Build a diversified portfolio that can weather any market conditions. 100. Firstly, it's important to note that any gains or profits you make from buying and selling stocks are subject to capital gains tax. 101. If you hold the stock for less than a year, you'll be subject to short-term capital gains tax, which is taxed at your ordinary income tax rate. If you hold the stock for more than a year, you'll be subject to long-term capital gains tax, which is taxed at a lower rate. 102. One strategy that many investors use to minimize their tax liability is tax loss harvesting. This involves selling losing investments to offset gains you've made in other investments, thereby reducing your overall tax bill. 103. For those who are new to investing in the stock market, it may be helpful to work with a financial advisor or broker. 104. One of the most obvious signs is when a stock's price has reached your target price. If you set a goal for how much you want to make on a particular stock and it has reached that goal, it may be time to sell. 105. Market is on an upswing. It may be a good time to sell some of your stocks and take some profits. 106. If a company is experiencing financial trouble, such as declining revenue or mounting debt, it may be a sign that it's time to sell. 107. Not doing your research. One of the biggest mistakes that investors make is not doing their research before investing in a stock. 108. Another mistake that many investors make is trying to time the market. 109. The problem with this approach is that it's nearly impossible to predict market trends accurately. 110. Instead, focus on maintaining a diversified investment portfolio and staying the course during market fluctuations. 111. Instead, focus on making rational decisions based on your investment goals and research. 112. One of the most important things to keep in mind when investing in a volatile stock market is to stay focused on the long term. 113. However, it is important to remember that bull markets don't last forever, and eventually there will be a correction or even a bear market. 114. Quality stocks tend to perform well in bull markets as investors are willing to pay a premium for them. 115. In a bear market, stock prices are falling and investors tend to become more cautious and risk-averse. 116. These stocks include companies that produce essential goods and services such as food, healthcare, and utilities. Defensive stocks can help investors weather the storm of a bear market and provide a steady stream of income. 117. It is essential to remember that investing in a bear market requires patience and a long-term perspective. 118. By focusing on defensive stocks, taking advantage of lower prices, diversifying your portfolio, and maintaining a long-term perspective, investors can weather the storm of a bear market and benefit from the eventual recovery of the market. 119. Fundamental analysis involves evaluating a company's financial health, growth prospects, and competitive landscape. Technical analysis, on the other hand, involves analyzing stock price trends and patterns to predict future price movements. 120. Thirdly, it is important to have a long-term perspective when investing in the stock market. 121. Fourthly, you should pay attention to fees and expenses when investing in mutual funds or exchange-traded funds, ETFs. 122. As we conclude this journey, it is important to note that investing in stocks is not a get-rich-quick scheme. 123. Platforms like Udemy, Coursera, and Skillshare offer courses ranging from beginner to advanced levels. 124. Some popular stock market simulators include Investopedia's Stock Simulator and Wall Street Survivor.